Okay, let's unpack this one.
Yeah, Yatharth Hospital. Interesting case.
Absolutely. Yatharth Hospital and Trauma Care Services Ltd. We're doing a deep dive today,
hmm
and you've handed us, well, quite a stack of sources here.
We've got the annual report from March 24. There's a CRISIL credit rating.
Right, that's the November 24 rating,
Yeah.
plus the Q4 FY25 earnings call.
And the presentation that went with it from May 25. And some recent announcements, too.
Got it. So our mission, really, is to pull out the most important nuggets of knowledge for you.
Help you get well-informed and quickly about this company.
Exactly, because they seem to be evolving pretty rapidly in the healthcare space.
They certainly are.
So let's start with the basics. Who exactly is Yatharth Hospital? Why should we be looking closer right now?
Well, Yatharth Hospital is essentially a fast-growing super specialty hospital chain.
Okay,
Their main footprint is in North India, so think Delhi NCR, Uttar Pradesh, and they've expanded into Madhya Pradesh too.
North India focus, got it.
And they've definitely been making waves lately.
And I imagine the numbers back that up. When you look at their financials, they really tell a story of growth, don't they?
They absolutely do. The acceleration is quite striking.
What's the headline figure that really jumps out?
I'd say it's the top line growth combined with keeping margins healthy. That's quite a feet in healthcare.
Right.
So for fiscal year 25, their revenue jumped, get this, 31% year over year.
31%.
Yeah, reaching $8,805 million. And importantly, their EBITDA, that's earnings before interest, taxes, depreciation, amortization,
Uh-huh.
that increased 22% to $2,202 million. And they maintained a pretty healthy 25% margin.
Okay, so growing fast, but still profitable growth.
Exactly. And their profit after tax PAI, that grew 14% to euro 1,306 million, which is a 15% margin. So efficient growth.
That's key.
And it's not just financials. They've physically expanded too, reached over 2,300 beds by March 2025.
Wow.
And they've got 3 new hospitals, adding over 600 more beds, set to be operational pretty soon, Q1 FY26.
Okay, so significant capacity increase. But what's really driving this growth? Is it just about adding more beds, or is there something more maybe strategic going on?
That's a great question. Capacity is part of it, sure. But the real engine, I'd say, is their strategic shift towards tertiary and quaternary care.
Okay, explain that a bit more. Tertiary and quaternary.
Think highly specialized medical services, complex surgeries, advanced treatments for really serious conditions.
High-end stuff.
Exactly. And what's fascinating is that specialties like oncology, nephrology, neurosciences, orthopedics, transplants, these are actually outpacing general medicine in revenue terms.
Ah, so it's not just more patients, it's patients needing higher value care.
Precisely. It's a shift up the value chain, attracting cases that, well, command better margins and maybe a different patient demographic.
So that's a really interesting insight. They're not just getting bigger, they're strategically changing the kind of services they're known for.
That's exactly right. They operate this chain of super specialty hospitals focused on that high-value tertiary and quaternary care.
Mm-hmm.
And crucially, their focus is shifting towards cash and insurance-based patients, so non-government business.
Better payment cycles there usually.
Generally, yes. Plus, they're pushing medical tourism and attracting international patients, too.
Okay. And geographically, where are the main hubs?
Mm-hmm.
And are certain services bigger earners in specific locations?
Good question. Looking at FY25, Noida Extension was the real powerhouse, 37% of revenue.
Okay.
Greater Noida was next at 31%, then Noida City at 20%. Hansi Orcha, which is an MP, was 7%.
Right.
And Faribad, that's a newer one, contributed 5% in its first 10 months or so.
So still quite NCR-centric, but branching out.
Definitely. And by specialty, oncology stood out. It was 10% of the group's revenue overall. But get this, it was 19% in Noida Extension alone. Clearly a focus there.
Wow.
Cardiology was 12% group-wide, nephrology, urology 11%, and neurosciences 9%. So it's diverse, but you can see those high-value specialties leading.
So that leads to the big question. What gives them an edge? What's their secret sauce in this really competitive Indian healthcare market?
Well, one thing that's really fascinating and maybe a bit unusual is their asset ownership model.
Asset ownership. How does that work?
So unlike many players who might lease buildings or operate hospitals under management agreements.
So the O&M model,
Yeah.
operations and management.
Exactly. Yatharth owns its major hospital assets outright. Freehold, the land, the buildings.
Ah, okay, so they own the whole facility.
Pretty much. And that gives them, much better control over margins in the long run. more stability.
That makes sense. Less reliance on landlords or partners.
Right. Plus, they're very technology forward. They use multiple robotic surgery platforms, for instance,
Okay.
and they have JCI and NABH accreditations.
Yeah.
These are basically top-tier quality certifications, international and national, big signals of quality and safety.
Improved for attracting patients, I imagine, especially international ones.
Definitely. Combine that with a strong regional brand, being a first mover in some specific Delhi NCR micro markets. It helps them attract top doctors and other talent as well.
You mentioned medical tourism earlier, or medical value travel.
Hmm.
That point really caught my eye. India's cost advantage is pretty significant, isn't it?
Oh, absolutely. It's huge. We're talking something like 67% to maybe even 91% lower surgical costs compared to OECD countries.
That's a massive difference.
It really is. And their hospitals being close to major airports, that just makes it even easier, more attractive for international patients looking for high quality care that's, well, much more affordable.
Makes sense. And operationally, with all this growth, are they getting more efficient? Or are there growing pains?
Good question. The metrics suggest they are getting more efficient. Their overall occupancy rate climbed to 61% in FY25, up from 54% the year before, so filling more beds more consistently.
Okay.
And their ARPOB, that's average revenue per occupied bed, that rose 8% year over year to 30,829, which means they're earning more per bed, likely from that shift to higher value procedures or maybe better pricing power.
And is that consistent across hospitals?
While some are doing even better. Noida Extension's ARPOB was up 11% to over 38,000.
Yeah.
Greater Noida's was up 16% to nearly 35,000.
Wow, strong growth there.
Yeah. And inpatient volumes grew 34%, outpatients 16%. Interestingly, the average length of stay held steady at about 4.3 days.
Suggests they're managing patient flow efficiently, even with more volume.
Seems like it.
Okay, so impressive operational performance on top of the growth. What does this all mean for their overall financial health? Let's talk about the balance sheet.
Right, the balance sheet. It tells a story of, frankly, exceptional financial strength.
Really? How so?
The company is just incredibly well capitalized right now. They had a net cash position of over 5,000 million. That's 5 billion as of March 2025.
Net cash. So more cash than debt.
Way more. Their debt to equity ratio has basically dropped to near zero.
Wow. How do they manage that?
It's largely down to deleveraging. They used funds from their IPO and also did a QIP, a qualified institutional placement, late in 2024.
Ah, raised equity to pay down debt.
Exactly. It cleans up the balance sheet significantly.
That kind of liquidity sounds amazing. But is there any downside? Like, are they sitting on too much cash? Or does it just fuel their future plans?
It mostly seems positioned to fuel growth. Their shareholder equity actually doubled year over year to over 16 billion.
Doubled.
Yeah, partly thanks to that QIP money coming in. And their actual borrowings, they plummeted from over 800 million down to just 41 million.
Incredible drop.
It is. And their current ratio, which measures short-term liquidity, is super high at 7.6x.
So extremely liquid.
Very. It basically means they have a ton of dry powder.
Dry powder.
Yeah, substantial cash reserves ready to deploy. They can fund their upcoming expansions without having to rely heavily on taking out new loans. Gives them huge flexibility.
Okay, that financial muscle certainly positions them well. So let's pivot. Where does it get really interesting? What's next for Yatharth? What are these ambitious plans?
Well, their plans are definitely ambitious, maybe even aggressive.
Lay it out for us.
Okay, so they're planning to open 3 completely new hospitals. That's over 700 beds combined.
3 new ones. Where?
In Model Town, Delhi, and also in Faridabad. And they're aiming to have those operational very soon, by Q1 FY26.
Okay, that's fast.
It is. Plus, they're doing brownfield expansions.
Meaning adding to existing sites.
Exactly. Adding 200 beds in Greater Noida and another 250 in Noida Extension. That's planned over the next, say, 24 to 30 months.
So the target is?
The target is to get over 3,000 total beds by fiscal year 2028.
Wow. And any plans for buying other hospitals? Inorganic growth?
Yes. They've explicitly said they plan to look for at least 1 new inorganic acquisition each year focused on North India.
Okay, so organic expansion plus acquisitions, a dual strategy.
Seems like it. They're clearly aiming for market consolidation in their region.
And how does their service strategy that focus on high-value stuff tie into these new hospitals and expansions?
Oh, it's completely linked.
Yeah.
These expansions are designed specifically to support and actually accelerate that shift.
So building facilities equipped for complex care.
Precisely. The goal is for those high-value specialties like oncology and transplants to make up more than 60–70% of their total business.
Okay.
And that's enabled by buying new advanced equipment, more robotics, specifically for these new and expanded facilities.
And medical tourism fits in here, too.
Absolutely. They're accelerating that push, setting up new information centers, building partnerships in places like Nigeria, Uzbekistan, Mauritius.
Strategically chosen countries, I assume.
Right, to drive international patient flow directly into these enhanced facilities.
Makes sense. Now, what has management actually said about their financial projections? With all this spending and expansion, what are they telling investors to expect?
Well, based on their earnings call back in May 25, management is projecting they can maintain a 30% annual revenue growth rate. Still 30%, even with a bigger base.
That's the guidance. They expect margins to stay pretty consistent with Q4 FY25, so around that 24–25% mark.
Okay.
Though they did acknowledge there will likely be some short-term margin dilution from the new hospitals coming online.
Right, because new hospitals take time to ramp up.
Exactly. It's normal. They estimate about 12–15 months for a new large hospital to reach break-even.
Got it. And what about ARPOB and receivables?
They expect ARPOB to keep climbing maybe 10% plus year over year. And they actually expect receivable days to decline as more revenue comes from the non-government side in these new facilities.
Interesting. Okay, so that's the growth story. But every deep dive has to look at the full picture. Challenges, risks, nuances. What are the key watch-outs for Yatharth?
That's an important question. One area that definitely needs watching is their working capital cycle.
Okay.
They tend to have elevated receivables money owed to them, especially from government business. This results in receivable days being quite high, around 120 days.
120 days, that's like 4 months. It is. And CRISIL, in their credit rating report, pointed this out. They noted gross current assets were high, 217 days, back in March 2024. Now, management emphasizes they're successful at converting these receivables to cash eventually. But both the auditors and CRISIL flag these high receivables as a potential risk area, something to monitor for cash flow implications.
Okay, working capital management is key.
Yeah.
What else?
Another point is geographic concentration.
We touched on that. Still very NCR focused.
Very much so.
No.
Delhi, NCR, UP, Haryana. The ramp up in the newer areas like Jhansi and MP and Faridabad, it hasn't fully materialized yet.
So there's execution risk there.
There's moderate risk, yeah. Until those newer markets are contributing more significantly, they're heavily reliant on that core NCR cluster.
Got it. And you mentioned that temporary margin dip from new hospitals. Can you just elaborate a bit? How significant might it be?
Yeah, it's expected to be temporary, like we said. Big new hospitals just don't turn a profit on day one.
Takes time to fill beds, build local reputation.
Right. So you'll likely see a slight dip in the overall company margin for a few quarters as these big facilities come online. But the expectation is it normalizes as they mature, hit higher occupancy, become more efficient. Standard J-curve effect, really.
Okay. And let's revisit that asset ownership model. We called it a strength, but is it also maybe a constraint? It sounds capital intensive.
It absolutely is capital intensive. That's the trade-off.
What kind of numbers are we talking?
Well, for their new brownfield expansions, the CapEx, capital expenditure per bed, is around $7 to $8 million.
Wow. Okay. That's a lot upfront per bed.
It is. Compared to an asset-light O&M model, it requires much more capital. But
the payoff is? The
payoff is potentially superior margin resilience, better control over operations, quality, and long-term costs. It's a strategic bet that owning the core infrastructure pays off, especially in healthcare.
Owning the kitchen versus renting the stove, as you put it earlier.
Kind of, yeah. More control, maybe higher quality output, but definitely higher initial investment.
Any other financial nuances we should be aware of?
Yes, one important point from the FY25 results. A large chunk of the increase in their reserves came from the premium on that QIP they did.
Okay.
It wasn't purely from recurring business profits. So if you're analyzing trends in things like return on equity or return on capital employed,
ROE, ROCE.
Right, you'd want to sort of mentally exclude that one-time QIP premium to get a clearer picture of the underlying business profitability trends.
Good point. Normalizing the numbers and their credit rating.
Right. CRISIL rated them A with a stable outlook.
A stable. What does that signify?
Well, the A is decent, indicates good credit worthiness. It was actually an upgrade. mainly because they paid down debt and showed good profitability.
Oh.
But it's still constrained, according to Crisell, by that working capital intensity, the high receivables, and the geographic concentration we discussed. Stable means Crisell doesn't expect the rating to change in the near term.
Okay, puts it in perspective. So bringing it all together, what does this all mean for you, the listener, after taking this deep dive with us? What's the big picture takeaway?
I think Yatharth really stands out among many Indian hospital chains right now. You've got superb revenue and, importantly, asset growth, strong margin resilience, partly thanks to that ownership model, and a balance sheet that's significantly deleveraged, giving them firepower.
Strong foundation.
Definitely. And a clear strategy focused on high-value care, tapping into international patients, and really trying to build a dominant network effect in their North India region.
But as always with such ambitious plans, execution is everything, isn't it? Especially navigating those challenges we talked about.
Absolutely. The underlying business looks fundamentally sound. It seems poised for this high-capacity, high-growth phase, which could support a premium valuation argument.
If they deliver.
Right. The key really lies in their continued execution. Can they manage those receivables effectively? Can they scale up these massive new hospitals efficiently? And can they successfully diversify beyond that core NCR cluster to really cement their position? Those are the big questions going forward.
Okay, so as you reflect on this deep dive, here's maybe a final thought to consider. How might a company's commitment, like Yatharth's, to owning its core assets despite that higher upfront capital cost, ultimately provide a more stable, maybe more profitable long-term path compared to the asset-light models we often see? Certainly in a critical sector like healthcare, where quality and control are paramount.
Yeah. Stability versus flexibility, control versus capital intensity.
Something to mull over until our next deep dive.